Welcome back to the channel. We're going to look at something a little bit different this evening. We're going to look at some options on SPY, the Spiders S&P 500 ETF Trust. We're going to look at selling options out of the money on SPY, both above and below the market, using expected move for a February 23 expiration cycle, which is 29 days. So if you are new to options, this is probably going to sound pretty confusing. Hopefully you can follow along. As always, leave some comments. Let me know your questions. Try to answer those in a reasonable amount of time. And if you're an experienced options seller, maybe you'll take something away from this. So let's check this out. So we are going to go into, by the way, on the left-hand side is an options chain. The right-hand side is a chart. The left-hand side is Thinkorswim. It's a simulation account used for videos. So here is our different expiration cycles on our left-hand side. We're going to go to the Feb 23s, which have 29 days till expiration. And what we're going to do is we're going to take the expected move for this 29-day cycle. And then we're going to go over to the chart. We're going to take the closing price of today, which is the 19th of January 2023. We are going to add that to the closing price, get an area on the chart, and then we are going to subtract that from the price. Also get an area from the chart, and then we're going to see what we could get for a credit. So this will be selling options. So when you sell options, you get a credit into your account for whatever you sold that option for. And then since options have a finite life, that option will fluctuate in value due to the options Greeks and the price movement. But let's say the price doesn't get to, let's say the SPY, I should say, doesn't get to that option price you sold, you'll keep that credit that you received on the day of on the day that you sold that option. So let's go over to the chart real quick on the right-hand side. And this is a daily chart of SPY. And I have 3 white lines on the chart. We have a white line up here at 406.64. We have a white line, a vertical white line. That represents our February 23rd. That is our timeline. And the verticals are our timeline. The horizontals are our price line. And then below the market, we have a 370.64. That is below the market, 370.64. And basically dead center is 388.64. So keep all that in mind. The 388.64 in the middle of the chart, the red horizontal, is our price line of where we closed today, the 19th of January, 2023. Above the market is our expected move to the upside line, 406.64. Below the market is our expected move to the downside, 370.64. So what we're going to do is go back to the left-hand side of the screen, and this is our options chain. In the center, we have strike prices. The strike prices represent prices along the chart. So right in the center, we have 389. We have 388, 389, 390. That represents where the stock is currently at. And if you go to the right-hand side of the screen, you can see we're right at 388. So that horizontal line basically represents the center of this chart here, this options chain on my left-hand side. So what we're going to do is we're going to look up to the right-hand side of the options chain. Might be a little hard to see if you're on a mobile device. but it's up here. I don't have actually, if I click this, maybe you could see it on the screen recording software. It's up in here. So it tells us 20.72%. And then in brackets next to that, it tells us plus and or minus 1808. So we're going to call that $18. So there's a math formula out there that tells us that it's an options math formula that tells us in 29 days, which is our expiration over here, the February 23rd, February 23's cycle, 29 days, there is a expected move for the price of SPY of plus and or minus $18 from where we are currently at right now, which is 388, 389, 390, right in that time frame. So what we did on our chart on the right-hand side of the screen is we went up $18, put a white line, went down $18, put a white line. So this is our zone for SPY, all the way up to 406.64 and all the way down to 370.64. But there is another factor. The other factor is time, which is our white vertical line right here. That represents our time frame. So the price is expected to move either plus and or minus $18 within this amount of time. So as we get closer to our time scale, our time frame, our timeline, I guess I should say, the Feb 23rds, the options that are further away from the price, further out of the money, it's called, are becoming less valuable over this time cycle. So if the price basically stayed right where it's at right now and went up and down, as we approach our timeline, our options, now we haven't sold them yet, we're going to get to that are up here at 406 and down here at 370. Let's say we got $200 for those. Well, that $200 is today on the 19th. But if we went out a week or two, those options might only be worth $100 compared to what we sold them for today, which we'll say, in theory, could be $200. So we're making money on this position. So we're going to come back to the options chain. I'm just kind of going to go over to the chart a little bit more. If the price rallies, and don't forget, the options that are closest to where the price is trading at right now, or in a day, or in 3 weeks, or whatever, those are the ones that have the most value. They are the closest, or they are at the money. So if the price rallied from here and it got closer to our 406 strike price, that's what it's called, those would actually become more valuable. And since we sold them for, let's say it's $100, maybe now they're worth $200. So we're actually losing money because we could have waited in time and sold them for a higher price. So you can think of it as wherever the SPY price is for this example. So right now it's at 388.64. Those options that are closest to that price have the most value. And the higher or the lower you go, those options start to decrease in value. They are further away from the money. Now, like I said, there is different factors that price options. The Greeks, there's volatility. That's a big one. So that's for a different video. So let's clean this chart up. And one thing I want you to remember is that the options that are closest to where the current price is, and that fluctuates every day. As you know, the markets go up, the markets go down. So options fluctuate in price. That's where, your strategies, your models come in to start to increase that edge, give you an edge over the other traders. So remember, the options that have the most value are right here where the price currently is at 388, 390. Keep in mind our 406 and our 370. And why do we have those on the chart? Because the complicated options model formula tells us that within 29 days, there is a plus and or minus $18 expected move for the SPY between now and February 23rd. And that's for this time frame, and that does change as well as price moves, but that is right now. So what we're going to do is, if we think, for whatever reason, whether we like the chart, we have some other model, if we think that the price is going to stay within this range, the 370 to 406, in 29 days, what we can do is we can take advantage of that. We can put on what I like to call basically a neutral trade. You're not really bearish. You're not really bullish. You kind of think the price is just going to ping pong in between a range, and you want to try to make some money off of it. So what we're going to do is we're going to go to the options chain. We're going to scroll down. Scrolling down, actually the price increases, and scrolling up, the price decreases. On the right-hand side of our screen are the puts. On the left-hand side of our screen are the calls. Calls go up, puts go down. Now, like I said, there's a lot of factors that can change the way you say that or the way you might think about that. The calls are above the market, at least the ones that we're going to deal with right now. So we want to get to the 406s. So we're going to go down our center, which is where our prices are. We have 406, and we're going to press the bid. We want to see what this option is worth for a credit right now. This is also a 20 delta option. The Greeks are for a different video, but let's click this and see what we'll get a credit for this. So this one options contract on SPY at 406 that expires in 29 days, $201 credit. And if we press confirm, we can see that this is selling for $200 right now, and the buying power effect is 61.19. Something to think about and keep this in mind. And like I said, if you're new, this might all be very confusing. If it says max loss is infinite. So the reason why it says that is because stocks can go up in theory to an infinite number. They can just keep on going. I mean, look at Berkshire Hathaway. Stocks can only go down to zero. They can't go below zero. They're either at zero and they're worthless, or they're worth, whatever, fractions of a penny. So in theory, you could sell this 406 and the market could rally and go way, way higher than your 406. And the higher it goes, the more of a loss you have. That's why it says that. So that is a $200 credit. You'll get credited that $200 into your account instantly as soon as you sell this option, if that is what you want to do. Let's delete that. Let's go over to our put side, which is our puts are below the market, our 370s. So we're going to scroll up here. We're going to go to our 370, which is also a 20 delta. We're going to click that. Our puts are usually valued at a higher premium. And as you can see here, this is the $262 put. So you can see that now this tells us our max loss for this position, if we put this on, is $36,738. That's it. That is the most you can lose on this because it can go to zero. Now, the infinite number is way, way higher. It's infinite is the reason why it says that. Now, we know, though, that our options formula tells us that there is only an expected move of $18 plus and or minus between now and our 29 days. So, of course, anything is possible. Is SPY going to go to zero? Probably not. Maybe, but probably not. Is it going to rally to, some crazy number between now and 29 days? Well, it could. But our formula tells us that now we can have multi-standard deviation moves. But there is a plus and or minus $18 expected move in place between now and the 23rd of February. So what some traders do, and there's also there's ways to cap your risk on this trade as well. You can do an iron condor on this, not a strangle. This is called a strangle. You can go ahead and sell this call for $201. And you'll get credited. You'll have a credit of $201 in your account instantly. And the way you make money on this is as long as the SPY stays below your 406 plus the credit you received between now and your timeline, which is what? February 23rd. You keep all of your $201, of course, minus your commissions. So the price can go up a little bit, it can go down, it can go sideways, it can go back up, it can rally, it can tank. As long as it stays below your short strike, which is your 406, you'll keep that $201 or whatever the number may be after your commissions. And the same goes for the put side. If you sell that put down here at 370, you keep, well, if the market trades, wherever the market trades in between now and your expiration, which is the 23rd, you'll keep that full credit, which is 262. So there's traders out there that are, neutral traders. And they sell options for whatever reason at whatever strike price they determine is, whatever their models say. And that's how they make an income. So you'll hear like, I'm an option seller. I'm an income trader. I'm a neutral, delta neutral trader. And the reason why this can be so powerful, you can also get yourself into a lot of trouble. So you definitely want to understand what you're doing here. Is there's a lot of traders who try to capture, they try to buy bottoms, they try to capture these rallies, they try to sell tops and go short, whatever the case may be. The option sellers can say, I'm going to sell an option up here. I'm going to sell an option down here. I know how much I can make. In theory, I have, unlimited risk for my calls. I know my, in theory, going to zero risk. I don't care where the market goes in between now and my expiration. I'm going to put on my trade. I'm going to collect my, 2, 3, 4, 5, whatever it is, $100,000. And I'm going to sit back, let those options lose value. That's what happens. They lose value over time, especially the further away from they are from the current price. And I'm going to be okay with that. I'm not going to try to go short. I'm not going to try to buy bottoms. I'm going to sell my options. I'm going to collect my money today and then let the market do its thing. Now, of course, there's a lot of caveats. One of the caveats is is not having stops on your options. You can do that. You can determine a risk, and that's all you're going to take. You can also you want to have a plan that if the market goes against you, because you could sell options for months or even years and make a great living, and then have one trade go against you and lose it all, if not more. So there is definitely, it's not set it and forget it kind of trading, but there is strategic ways to go about it. One of them, which I just shared, is using the expected move, but then also consulting the chart. You also want to consult that the product that you're selling options on is liquid. Like the SPY is very liquid. You'll have tight markets. You'll be able to get in and out of your options very, very easily, compared to a super low price stock that has a very, very wide bid-ask spread. Maybe not the best to be selling options on, because if you want to get out, you're not going to be able to. I've done it. I've been there. It's not fun when you want to get out of a trade and there isn't a buyer there to buy your option from you. You sold it. You got filled. There's no buyer there. The volume's low. It's a huge spread. Not fun. Not worth it. So that is just a little glimpse of some of the potential with options. Now there's a whole load of risks that come along with that. It's not just, I'm going to collect my $500, turn my computer off, turn it back on in 29 days, and have made that $500, rinse and repeat. Of course, that can happen, but I wouldn't say that's the smartest way to go about trading options, especially naked, which is what these were. You sell one option and then another one. They're both naked. You have, in theory, unlimited risk to the upside. You know your downside risk can go to zero. There's ways to cap that risk. It's called a vertical spread. Or if you do above and below the market, like we talked about, or 370, 406, and you want to cap your risk, you don't want unlimited risk, you could do what is known as an iron condor. So it's a lot, but it's definitely something worth learning about, in my opinion. There's a lot of ways to use options along with stocks. You can use options on futures, and there's definitely some ways to it's worth thinking about and learning. If you want to know some more about it, I could probably put together some more videos. There's some different strategies. There's probably some more simple strategies, some covered calls that I could go over. Let me know if you're interested in that. I could put a video together for that as well. Before I wrap this up, guys, I also want to talk about that. So we have the expected move. Now, this is Thinkorswim. This is a virtual account for making videos and testing trading strategies. So let's zoom out real quick on SPY. This is the SPY once again. Something that I have looked at in the past is taking major highs and major lows. So we have a major high right here at 431. We have a major low down here at 348. So the price right now is at 388. So you could take the major high over here at 430, 431, go into your options cycle. This is 29 days. There's different time frames. There's different monthly, there's weekly expirations. We're in the 29 day, and we were at 431. So if we go up to 431, it's very, very far away from the actual price, from the money, as a low delta. So it's not going to be worth much. Remember that options closer to the price have more value than options further from the price. But there is times, though, when volatility is super high that you can get good credit for options that are way, way out of the money. But if we wanted to sell a call option up there at 431, we would only get $9 for it. That's it. $9. It would take up $3,800 in buying power from our account. Only $9. Not worth it. Can't make any money doing it. So there is a limit. You can't just go out to infinity in theory and sell calls, sell a bazillion calls. You're just not going to get paid for that. But you could take, this high over here, 410, which is another major high. Go to the 410s, which are right here. They're a 14 delta. You're going to get $125 for those. Now you can make some money. Keeping in mind, though, that the price, you don't want the price to rally up to there between now and your expiration. So there's a lot of ways to look at options, but you can use them as a way to create income if you go about it in a strategic and smart way and don't get too greedy. You can cap your risk, which is selling an option and buying an option called a vertical. You know your max risk, you know your credit all ahead of time, no guessing involved. So that's something to check out on the chart. Something that I have used is I've obviously used the expected move. And like this, we put the expected move on the chart. So we have 406 and we have 370. But also right around that 406, we can actually get a little bit further away from the money, which is a little bit safer. And it's a major high right here at that 410, which we just went over to the chart. So maybe that is a slightly more strategic area to be selling options above that. So we're actually further away from our expected move of $18. We're above a major high. That's two things, in my opinion, of course, not financial advice, that are going for us. And you're still getting a pretty good credit there at $125. So that's enough rambling on here about options and selling. There is a ton of strategies. If we click down the strategy thing here, we have single options, we have verticals, ratios, calendars, diagonals, straddle, strangled, covered stock, butterfly, iron condors, regular condor, vertical. There's all kinds of option strategies. You can buy options, you can sell options. Let me know down in the comments your thoughts. Guys, appreciate all the subs. Join us here on the channel. Turn on the bell notifications. Hit the thumbs up. And I'll catch you guys in the next, probably, crypto video. All right, take care.